Hi, I'm Greg Uland with Reynolds & Reynolds, and this is Connected. Today's a fun day. I have an in-studio guest. It's none other than Steve Greenfield. If you don't know Steve or haven't seen his stuff, you've been hiding under a rock somewhere. It seems like he's at every single conference, every single convention that I can think of. But Steve is a general partner at Automotive Ventures. Steve, thanks so much for joining.
Greg, thanks for having me.
Of course. It's great to have you here. So you've got a ton of experience. You've done a lot of different things inside of the industry. I think like about all of us, right? You get in and then you start having fun, and there's just not another avenue to go because nothing's going to be as fun as what we do in automotive retail. So, Steve, with your experience, I was wondering if we could just jump in. Like, you've got a lot of stories. You've met a lot of people. You've done a lot of things. What's the most interesting story, just off the top of your head? Like, what's the most interesting story that you can come up with around your experience in our industry?
That's a good question. I think I'd go back to maybe my first job.
Okay.
So I, like a lot of folks with this industry, I just kind of stumbled into the industry, and I ended up going out to interview for a technology manager at an auto auction outside of Toronto where I grew up. And it was a brand new position. And I walked into the general manager whose family had owned the store, or owned the location and sold it to Manheim.
Okay.
And he hired me at $25,000 a year. Base pay, and it was low back then. Even it sounds very low now, but it was low back then. And $10 for every subscription to Manheim.com I could get for dealers, which was $50 a month back then.
Okay.
And the funny thing was, and the reason it really resonates is 3 months later, he calls me back into his office and said, "Steve, I think we need to renegotiate your pay package." And, I was relatively early in my career, and there wasn't such a thing as SaaS and recurring revenue at that point. But he said, I said, "Well, why is that?" And he said, "Well, you're going to end up, at this pace, you're going to end up making more money than anyone here." And there were 400 employees than me, even more than my assistant general manager. And, what I should have said is, like, is that a problem? He was paying me $10 one time for a $50 subscription.
Yeah, so 20%
So
net.
it was amazing, right? Yeah. But as it turned out, he did recalibrate my pay. But by that point, I was already talking to the corporate office in Atlanta and trying to orchestrate, moving down to Atlanta, which I did, on my 12-month anniversary as soon as I was eligible. So, but it's interesting. I can imagine for him now, at my age, thinking about the conversation, it must have been awfully uncomfortable for him to have that conversation. But yeah, the money was like inconsequential. But I also understand how disruptive that could have been within the organization to have this young punk kid who had just gotten hired, who was going to make more money. But there you go.
That's how variable comp works.
That's how variable comp works.
You do it well, you make
I think
money.
that a good philosophy I've always seen is like your best salespeople should make more money than the CEO as long as they're earning it.
That's right. Yeah, as long as you're getting the job done.
Right.
So, Steve, one thing I was doing a little research and prep before we were going to talk, and you mentioned Toronto. So obviously you're from the Toronto area.
I am.
But you got your undergrad degree at York, right? York University.
Wow, look at that.
And it was but the interesting part, because you're still a pretty fit guy, so I'm guessing you're still pretty active. But your degree was in health sciences, right?
It was.
So tell me about that path. Like, what was young Steve thinking? So I go to college, I'm going to have a health sciences degree, and I'm going to go do what?
Well,
I assume not.
It's
start a VC. Like.
Good for you. I mean, it was like I'd always been very curious around about business. Mm-hmm. So my intent was not to go down that path at all.
Okay.
It was to get into sort of undergrad business school and then eventually take an MBA and do something business related. Okay. I've always been fascinated by the public markets and financing and things. Even in my teenage years, I was a voracious reader of like financial newspapers. So but it did set me down a different path. I had been somewhat sort of active in high school and in college, but I just got really fascinated with fitness testing. So the stream that I did in undergrad was we were fitness testing all of the firefighters in sort of Southern California and the sort of like greater Toronto area and beyond. But we were also fitness testing the Toronto Maple Leafs.
Oh.
And growing up in Canada, hockey was like a religion.
Right.
And we were fitness testing all the NHL entry draft kids who were like these 17, 18-year-old kids who were like, 6'4" and 220 already that were super fit.
Yeah.
But it really got me hooked into this. Like, so I had planned on becoming either a fitness trainer for a professional sports team or do something within that area. But, as you come to find out, a lot of us toss away and have useless undergrad degrees. you come out and there are only a few positions out there.
Right.
So in the interim, like your personal training and personal training, I don't know if you've ever been trained or trained other people, but you're basically like a psychologist, right? You're handling people who need psychologists more than they actually need physical trainers. So it was an interesting pivot, but I was very glad when I had a chance to get into the automotive industry and take me down a very different path.
Yeah.
But it was, I could have been, I don't know, a trainer for either ideally like a major league team, but even a minor league team. I would have been on a very different path.
Yeah. Yeah, no, that's interesting, and who knows, right, where the career takes you?
Who knows? Exactly.
So you get into automotive at an auction, which is that's a grindstone to start on for sure, right?
It is.
You're working a lot.
Yeah.
But talk a little bit about your history in automotive then. So you started there. You said after a year you moved down to Atlanta, started doing other things with Manheim. So, but you were there for over a decade, right?
I was.
So give a little bit more of your background and your story. Kind of how you got to where you are now, from an aspiring personal trainer to a legendary VC.
Yeah, I'm very into the Cox organization. I was there for almost 15 years. I didn't quite make my 15-year anniversary. To your point, like I did a full year in the field at an auction in Toronto, which was the largest auction by far in Canada.
Yeah.
And probably out of the 89 auctions Manheim had owned at that time, probably top 5. So I really excited. I think we had 400 acres and it was a very large auction. So it was a great experience. I mean, I wouldn't have traded that for anything. And then luckily enough, that general manager that I just poked fun at, he was very, very supportive of me moving down to the U.S. So never a moment. If anything, he actually encouraged me to explore it. So I had really good kind of mentorship from the very beginning, thanks to him. And had the opportunity then to move to the U.S. And I didn't take it lightly. Like in his words, he said, "This has never ever happened before. Never before has anyone from the corporate office in Atlanta tried to encourage one of the employees from Canada to move to the U.S." So I didn't take that lightly.
Yeah.
So I figured, this is my opportunity now to get down and make my mark, et cetera, and maybe had a little bit of a chip on my shoulder. And 10 years at Manheim, which was a great experience, 5 of that overseeing international expansion and structuring joint ventures overseas in various countries around the world.
So how does that, can I pause there for a second?
Yeah.
I'm curious, sorry to interrupt, but you say joint venture. So why? Is that regulatory? Basically to start up a business there, you had to have a partner that was domestic in whatever country that was?
Well, it's a great question. Great question. So at the time that I was asked to move over from what was Manheim Consulting, we were using data to help the commercial sellers with price expectations and where to sell and channel selection. So I ran that for a while. And then in 2006, I was asked to move over to international.
Okay.
And so at the time, we underwent a 6-month consulting project with Boston Consulting Group, brought them in, spent a bunch of money. They did an exceptional job looking across all of Cox's assets. Okay. So at that point, you can think of like big cable system, delivering sort of like bandwidth into consumers' homes.
Yep.
Manheim was large. AutoTrader was growing quickly, but wasn't that large at that point. And then we had 5 different divisions for media, right? Television, newspapers, radio, et cetera.
Yeah.
And so they said, well, of all those assets, the one that is really transferable overseas was this physical auction business that Manheim had.
Okay.
So then they said, let's look top down and identify the top 5 to 10 countries that have the right mix of a good business climate, large and thriving new car and used car ecosystems.
Yep.
And some of the data underpinnings, because you look around the world, for example, very few countries have price guides. Very few countries have the equivalent of Carfaxes. Yep. And without those, we take those things for granted in the U.S. We have a very efficient ecosystem for both new and used. But imagine if you were a consumer on new and used and you couldn't go find a price guide. Like there was no Kelly Blue Book. I mean, you literally you're kind of flying blind. And it's really hard for a dealer then who's taking a trade-in if there's no price guide,
right,
and there's no Carfax. I mean, you really are like dealing with lemons, basically,
sure.
And you have to price things appropriately, assuming that this car has been repaired wrecked in the past because there's no data record of that at all. And that's true to today as well. Most countries don't have the equivalent of a Carfax. So as we looked around the world, we identified countries that would be good. And then circling back to your question, then what do you do to structure?
Right.
Well, it would be arrogant for us in the U.S. to say we're going to like go into China or go into Western Europe or Eastern Europe and bring this business model and not know the lay of the land and how business practices are orchestrated within these countries. So to answer your question in a very roundabout way, we did look at partners. In some countries, like in China, we couldn't own more than 50%.
Yep.
So the Chinese partner owned 50% plus of the JV, the joint venture. But in many countries, we could own the majority, but we needed somebody on the ground who had trusted relationships, who understood how business was run, that was a good cultural fit, probably more important than anything. And then we were able to structure a financial joint venture that just made sense to both parties.
Yeah.
And we did that. I spent time in 3 different cities in China.
Okay.
We opened an office in Dubai to serve the Middle East countries with vehicle inspections. We structured a joint venture in Istanbul to serve the Turkish market with an existing player. So opportunistically, Turkey would not have been on our list, except there was an existing player there that already had a business that looked a lot like Manheim.
Yeah. And
they were craving, sort of like business intelligence and knowledge from the U.S. Did a lot of work in Western Europe, and then started looking at, Central and South America, specifically Mexico, Chile, and Brazil. Spent a lot of time in those countries, really understanding also how we might enter. And around that time, the 2008 downturn hit,
Right.
and Cox, rightfully so, lost all appetite for anything international and pulled back from most of the joint ventures that we had structured.
Yeah, no, it's interesting. It reminds me of the Starbucks story in China too. I don't know if you're familiar with this, but very similar situation. But the partner there that Howard Schultz and team originally worked with, she said, "Look, we'll do this and I'll run this, but I have to run it. Like, we're not going to have Seattle tell us how to run a store in China. Like, people eat rice for breakfast here. We're not going to have pastries. Like, it just doesn't work."
Right.
So and they said, okay, let's do it. Now, China's their biggest market, like most consumer-facing companies, right? But same mindset. You just have to be open to, like, we don't necessarily know best, right? We don't know the consumers there or know the business model there, know the traditions there, and we need to operate with somebody to help us. So that's a good way to approach it. That's interesting.
Yeah.
So I kind of cut you off. So a lot of time at Manheim, and then because you've touched on a lot of different things throughout your journey too. So what else is in that background of yours?
Yeah. So after the financial downturn and Cox losing appetite to expand internationally, my job changed dramatically. I suddenly was responsible for looking at those 89 locations we had in the U.S. and trying to figure out which ones we should close.
Yeah.
So, which was heretical, right? Because Manheim had only grown through acquisitions and had never closed anything down.
Yeah.
They'd only grown. So for them to start looking and saying, which auctions make sense to close down. So the method for that was really looking at where we had duplication. If we had a city and we had 3 auctions, would it make sense that we could close one and not do too much negative impact to our business if the same customers were already using identical or very similar auctions in the same city? So, when in late 2009, the CEO of AutoTrader reached out to me, literally at my desk one day, gave me a call, and said, "Hey, are you available for breakfast tomorrow morning at 7 a.m. at a local Waffle House in Atlanta, an icon?" And I was like, "Of course."
Yeah.
I don't often get a call from the CEO of one of the divisions. So AutoTrader at that point was growing very, very quickly.
Yeah.
So anyway, a little inside baseball. So I meet him at 7 o'clock the next morning at a Waffle House close by the Cox office, and he intimates to me, he says, "Look, Steve, don't share this with anyone, but Cox is basically shopping a minority stake to sell to private equity in AutoTrader. And sometime the next month or two, we'll decide on which private equity company we engage with, and they're going to sell off a minority stake in AutoTrader. And as a result, we'll have new board members, but more importantly, we'll have an appetite to go execute on some acquisitions." And he literally, out of his back pocket, pulled out a piece of paper and said, "And I've got some companies that I'd like to go acquire. I don't have anyone to work for me to go help me acquire companies."
Yeah.
So he looks at me and he said, "What would you be interested in coming working for me and overseeing acquisitions for AutoTrader?" And I looked at him, and I probably waited like 10, 15 seconds, enough to be uncomfortable.
Yeah.
And I would love to come work for you.
As long as it's a variable comp package.
Yeah, exactly right. Exactly. I've been through that road before. But his response obviously immediately was like, well, how can you make a decision so quickly? And I said, well, let me help you understand what I've been doing for this last year. And as I told you, it's really been closing down auctions.
Yeah.
The auction general managers had nicknamed me Darth Vader, because they knew if they got a phone call from me, they were on our target list to potentially close down. And, it was very hard for a lot of these folks to process. We were going through this financial downturn and we were closing auctions down. Right. It wasn't in Manheim's DNA. So when I had a chance to go work for the fastest growing division for a great leader, learn a lot from him, and then, have these new board members that were private equity guys that were super smart and motivated to effectively what they call tuck-in acquisitions. Within 14 months, we had spent almost over $1 billion of their combined money, and we'd bought, in order, we bought Kelley Blue Book, vAuto, HomeNet, and then Vin Solutions. So, my role really had changed dramatically to understand, how dealers spend money on advertising. At that time, AutoTrader had 20,000 dealers spending $4,000 a month on advertising. So almost $900 million in recurring revenue from dealers, but all advertising. And then try to understand for those 20,000 dealers, what other products might they buy from us, right? So in some ways, I guess, I was part of starting the monster that Cox Automotive has become.
Sure.
Now with 37 brands or whatever it is. Because back then we started with one brand, AutoTrader. This was way before they even had thought about creating Cox Automotive by combining Manheim and AutoTrader. But we were trying to figure out what would make sense. Acquisitions like vAuto made sense. We could find dealers that used vAuto to stock the right car and price it correctly, would do dramatically better on AutoTrader. You've got the right car that consumers are demanding, and you're pricing it competitively. Their cars on AutoTrader would get many more fold the activity than the average dealer. We actually went after Vin Solutions, not for the CRM, but for the websites that they had. We attempted to buy dealer.com. And we couldn't afford the price that they wanted. I can talk those stories, till I'm blue in the face around these potential acquisitions that didn't transpire. Ironically enough, after I left, when Cox bought DealerTrack, they inherited dealer.com. Right. But, a website made sense because if you're on AutoTrader, the next step would be to click through to go to the dealer's website. And then the CRM was complementary to that because the leads that would come in off the website or off AutoTrader would have to go somewhere. They'd go into the CRM and have to be managed. So we just tried to be very practical. And, Kelley Blue Book made a lot of sense. Kelley Blue Book was very much an upper funnel and new car site. Yeah. Whereas AutoTrader was very lower funnel, meaning consumers within days of making a decision on buying a car, but very skewed to used. So, one of the key pieces of diligence in that acquisition was we found that in any given month, to our surprise, only 20% of the audience, AutoTrader's audience, overlap with Kelley's. They both at the time had about 20 million unique visitors per month, but there's almost like no overlap between these audiences. Yeah. The other thing that was interesting, maybe too much inside baseball, but at that point, AutoTrader was monetizing at $4.50 per unique visitor per month. Okay. If you took AutoTrader's revenue, that $900 million or $1 billion, divided by the monthly uniques, they were monetizing at $4.50. Kelley Blue Book, similar size audience, right. They were monetizing at 45 cents. Wow. So 10%. Right. So the combination of almost no overlap in audience, and AutoTrader had built this arguably over monetized. They'd monetized every single pixel on every single page, which was actually negative to the consumer experience. Kelley Blue Book was a rather, with all due respect, a very sleepy company that hadn't aggressively monetized at all. Right. And the combination, we were like, well, we can take that the non-duplicated audience and just sprinkle some of the AutoTrader magic into Kelley Blue Book and start to energize more monetization. And we wouldn't have to get it anywhere near AutoTrader's monetization. If we brought that 45 cents up to $1 or $1.50, it would have been a home run. Yeah, which we successfully did, not without some growing pains, but so it was an exciting time. And like I said, I left about a year after they decided to bring Manheim and AutoTrader together into Cox Automotive. It was the right time. I'd been almost 15 years, and it was time for me to go out to see if I could figure out something entrepreneurial myself to go do.
Yeah. Yeah, that's great. So I want to go there in just a second. It's interesting hearing you talk, and I'm thinking about, how all this comes together, right? And you hear that story, and it's like, man, that makes sense. And then we look back on it now, right? And we see where dealers are today and their ecosystem that they have, and it's like, man, I wish all this stuff actually talked to each other.
Right.
It's like there's still all these silos and trying to get data from one place to the next, and it's duplicated and it's inaccurate and it's spelled wrong over here, but it's right over here, so it's two different records. And it's I think everybody's dream to be able to just have that single, really record that's consolidated, that has all that information. Because you think about the power that it can have to have that single record. So I know it's still a struggle for a lot of dealers out there. It's like, man, I wish we didn't have 17 different places that we're tracking vehicles in and customers in.
Yeah.
So it's such a great mindset, and it's just the ability to execute can be difficult, right?
And at that point, the concept of an API was a new concept.
Sure.
Right? I mean, typically what was talked about is that you would buy a company and then you would effectively re-architect the software to be on a common code base. And this concept of an API would mean that you could run two different code bases and just have them intercommunicate the touch points that made sense. But that was a relatively new concept 15 years ago, and you see how that has evolved now. But it's amazing. To your point, it's awfully frustrating, I think, for dealers in general to say, I can go source what I perceive to be the best point solutions out there, best of breed. But then, the actual, where we fall down as an industry is those integrations. Mm-hmm. And it's like, I have duplication of I go to a new car manager's, desktop, and I see them have like 7 tabs open.
Oh, yeah.
And they're cutting and pasting VIN numbers back and forth between applications.
Well, and sometimes you'll even see sticky notes on the monitor for logins to each one of those.
Yes,
things.
That's right, exactly. So it's like, as much as there was this vision for what could be, an easier, better path. And by the way, all of that means we can't deliver yet on the utopian consumer experience, because if dealers are navigating from one tool to another, you can imagine what the consumer's experience is like, right? You hear stories all the time like, well, I already did a credit app online. Right. Why do I have to go into the store and do another repetitive credit app? Can't you use my information? And the salesperson is either unknowing, give them the benefit of the doubt. I won't call them lazy, but unknowing, because they're like, I don't even know how to retrieve that information to populate this other system where I need to actually submit your credit, because that was a lead form online. So we're still creating unnecessary friction to the consumers in that transition from going online to in-store. 15 years later, where we could all go to a whiteboard and map out what would be the ideal utopian experience, but in some ways we haven't made much progress, if any, during the last 15 years.
I know, yeah. So let's fast forward a little bit and talk about, we can talk as much about your other entrepreneurial ventures as you want to. I am curious, so, Automotive Ventures is the VC firm that you started 4 years ago?
Yep.
4 years ago?
Yep.
Okay. And by all accounts, growing pretty successfully, right? And you have a lot of companies in your portfolio. You can talk about that. But I mentioned when we kind of started, see you everywhere, but I don't know, and maybe I'm wrong, but I don't know that Automotive Ventures kind of has just the instant recognition. So talk a little bit about the VC firm, what you're doing there, maybe even why you started it, and kind of what you're looking to accomplish with it.
Well, I'm counting on this podcast putting me on the map.
We can do it.
All right, cool. So I didn't. My last corporate gig was with TrueCar. Left right at the beginning of COVID, like literally at the beginning of COVID. I think I resigned 2 weeks before we closed the office out in Santa Monica, before I got back to Atlanta. But I started publishing content on a monthly basis, and found very quickly I was getting entrepreneurs in the automotive technology space who were reaching out and saying, this is really thoughtful, helpful content. I'm struggling to raise money. Is there anyone that you know that might want to invest in my company? So I started to manage a list of angel investors, a lot of folks that I know, high net worth individuals, either executives at various companies and or folks that had exited and done well over the years. In some cases, the companies that I'd helped buy, and started to play matchmaker, literally off of a Google sheet. And I found very quickly it was frustrating for both parties. It was frustrating for the entrepreneur who appreciated the fact that I was introducing them to high net worth individuals that might invest, but there was no process, it wasn't managed, and there was no sense of urgency for these high net worth individual angels to interact with the
Right.
entrepreneur. And on the flip side, the angel investors appreciated the quote unquote deal flow, but none of it would be vetted ahead of time. So they were wanting more, they were craving more. So literally, to your point, like 4 months ago or 4 years ago, 2 days ago, 4 years ago, I decided to start a VC fund, and I had no background in VC whatsoever.
But you did have a lot of experience in M&A.
M&A, understanding how to
doing.
structure
Yeah.
deals,
Yeah.
Spent a lot of time obviously over the last previous 20 years with entrepreneurs in this space. And so I understood the ecosystem
Right.
well, how dealers spend money on services and how the OEMs do, et cetera. And along the way, very thankfully, had met a lot of high net worth, people who are now high net worth individuals
Sure.
and established relationships with them. But yeah, I talked to a few VCs and they all gave me, as you can imagine, the same advice, which is good luck.
Right.
You got no track record. Raise whatever small amount you can and get investing, because until you have a track record, no one's going to trust you with their money. It's like, okay, that's great, good advice. So we scraped together. The first fund was only $7 million,
Yeah.
but I will be eternally grateful to all of those limited partners, the investors, who had faith in me and had no reason to have any faith in me other than just the trust that I'd built
Sure.
up. And I think the thesis we have, which is being very vertically focused on automotive and mobility, and being small. Is working out really, really well. You and I have discussed before the call here or the podcast. We've now invested in 34 companies in 3.5 years. So pretty much like clockwork, we see 60 companies a month, of which we invest in a company every month and a half. We're on to fund 3, so we fully deployed that. First fund is fully deployed into 24 companies. We launched 6 months later. We started raising a vertically focused dealer fund, where we raised money from 80 dealer owners,
Yep.
dealer principals, and we've made 9 investments out of that fund. And by all indications, that model is really going to work, where you can effectively, before you ever invest in a company, you can run it by your dealers
Yeah.
and understand, is there a there? Like, will dealers buy this thing?
Right.
And get feedback. And then we can, once we've invested, walk it into a captive dealer base that's got 1,000 rooftops represented, and no obligation. The dealers aren't obligated to buy, but we've just spent their money investing in these early stage companies. We've vetted it with them. So at this point, shame on them if they don't try it out in 1 or 2 of their rooftops and then give feedback to this entrepreneur, so they can, we can really increase the learning cycles.
Yeah.
And also, the word of mouth, when a dealer says, hey, look, I've not only invested in this thing, but I've got it in a few rooftops and it's really working. Going to their 20 groups or whatever and, getting that flywheel going has worked out really well. And we're on to fund 3. We're on to our second mobility fund,
Okay.
which has more of a global thesis, anything mobility related globally. The first fund is fingers crossed and knock on wood, doing quite nicely in terms of returns. And, I think that we found a nice differentiated niche to be in, which is, like I said, be subject matter experts that are hyper well networked, and then be a small fund that can invest earlier than other VCs typically do.
Yeah.
And just be really, really intentional and work really hard to help our entrepreneurs, once we've invested, become successful. And that might mean, making customer introductions like we're doing for the dealer fund. It might mean introducing them to sales channel partners. It might mean helping them raise their next round.
Yeah.
It might be helping them hire the right people. It might be helping them review legal documents. I'm good for whatever. Like, once we've invested in a company, I'm at their disposal.
Sure.
To help them however I can. And, it's fun. My days are typically back-to-back Zoom calls with entrepreneurs who are pitching us,
Yep.
interspersed with conversations with our 34 portfolio companies, just catching up with them to figure out how I can help.
Yeah. Yeah.
It's super exciting.
That's
I would
fun.
literally do this for nothing.
Yeah.
It's exciting enough that I would do this for nothing. Thankfully, it's also lucrative.
Right. No, that's great. It's and you're growing fast too, right? So you mentioned, being small and being able to invest early, and that's really valuable, and it's your niche, and that's perfect. And we'll see how long you're able to stay there, right? And stay in that zone. But it sounds like with that fast growth, you mentioned for your entrepreneurs getting that cyclical feedback loop, right? And getting feedback quick and being able to make new improvements quickly. You're getting that same feedback loop with all of your investments, right? So I'm assuming, and you tell me, but as you make these every other month, right? As you invest in companies, at that rate, 10 a year, I got to imagine that you're learning too. So every one probably gets a little better and you gain a little more experience and it's just happening quickly. Is that a fair, I guess?
Yeah, you nail it entirely.
Yeah.
Like, it's amazing to me that now I have 80 owners that own 1,000 rooftops that literally every time I catch up with them, my first conversation is, how's business? What are you worried about? So I keep my fingers on the pulse of like how dealers are thinking about their business and what they're worried about and things they're seeing. And obviously when they get pitched a vendor and they like it, the first thing they do is text me. They're like, hey, have you heard of these guys? Do you like them? Should I be looking at them? And if it's early enough, they're on our radar now to go potentially invest. The flip side is very, very self-servingly, with every entrepreneur I talk to, I get smarter.
Yeah.
So I might be, looking at, I don't know, battery chemistry, EV battery chemistry.
Sure.
I know nothing about EV battery chemistry, but now I'm an expert because I've talked to like 12 entrepreneurs who all they're doing is they're building new innovations. They've already identified what they perceive to be a problem, filling that problem with a solution. And with every conversation, I get smarter.
Yeah.
And then, by the way, me getting smarter in these areas help our investors. So it's entirely a flywheel.
Right.
And like I feel like at all times I'm drinking through the fire hose, but I learn from the entrepreneurs that pitch us. I learn from the entrepreneurs we invest in. I learn from our investors themselves. And I think all sides of that equation benefit because as I get smarter, I can be very deliberate. Every time I see a company now, I'm like, who could benefit from this company? And I can send it on to 5 or 7 people.
Yeah.
And conversely, when a dealer, for example, says, look, I got this real problem and in fixed operations, I'm having this problem, then I can be like, man, which of my companies that I've already invested in would benefit from that tidbit of knowledge? And I can be communicating back to them real time. So yeah, I do think this flywheel that we're building, we've just started,
Right.
but it's only going to become more powerful the more we get investors and entrepreneurs and portfolio companies built out.
Yeah. So, all those inputs and all that experience, what stands out to you right now? So the next 2, 3, 5 years, like what's sort of the next big wave, do you think? Because you're investing in pretty early stage companies for the most part. So where are you kind of placing those bets? What do you think is going to be the next thing?
Yeah. So, I mean, I've been saying this for a while and still rather frustrated that I'm not seeing more. So over my, 25 years when I've gone to NADA, and I think I've gone now for 24, 25 years in a row, except for that one year when they didn't have it because of COVID.
Wait, they had it over Zoom. It was
The Zoom call. That worked out well. So hopefully those days never return. But no, I think that, the interesting thing is, and I have a thesis as to why this is the case, but, you walk around the halls at NADA or Digital Dealer, and 95% of all the solutions are focused on variable operations, right? It's like, get me one additional car sale, or help me make more gross, or help me follow up with a consumer that's shopping for a car. Very, very little on fixed operations. More so in the last 5 years, but still like proportionally very small.
Yep.
And then in the same vein, very few, maybe no vendors, and maybe because dealers don't want to hear this or haven't up until now, especially during COVID, how do I take costs out? And when I look at a dealer's cost structure, 80% of their cost is labor. And
Sure.
I've heard forever that turnover's high. I can't hire technicians. I've got 50-60% turnover with my salespeople. And, if I'm a dealer and I'm going, this is interesting, if 80% of my cost structure is human
Right.
capital, for every dollar I take out, that dollar flows to the bottom line. I get more profit, but more importantly, what are dealers worth? Dealers are worth a multiple of the earnings that they make.
Sure.
So if I can help the dealer pull the cost lever and take out costs. Well, what's been buzzworthy recently is AI. And
Yep.
I'm not a real fan of the stuff that I've seen, for the most part, in automotive. Love to hear your thoughts on that too. But there's been a lot of promises around AI that I don't think have really delivered yet for dealers. But I'm excited not so much about like the variable ops side, like more revenue, more about sort of like how do we automate processes. So our biggest home run company has been this company called WarCloud.
Okay.
And I'm not going to promote the company
Sure.
here, but what they do is they automate the process for a franchise dealer to submit the warranty claim back to the automaker.
Yeah.
Well, very few companies I've ever seen have a value prop that both allows you to take out costs while actually generating more revenue.
Right.
WarCloud's one of those unique companies that does
Sure.
that, right? I mean, walk around NAD, I don't think you're going to see many vendors that promise both. One or the other, sure. And my eyes have been opened by this company because I'm on the board. I've been an investor now for almost 4 years. It's done exceptionally well. And because they have a very clear value proposition to a dealer.
Yeah.
And I think that if you and I sat and we went to a whiteboard and we mapped out all the different operational centers within a dealer, we'd quickly find like, wow, there's a lot of people who are sitting down in front of screens doing repetitive tasks, either hourly, daily, definitely monthly. Things like monthly bank reconciliations,
Yeah.
part statement reconciliations at the end of the month, ordering new vehicles, and we would find all kinds of opportunities for repetitive tasks where we don't need to eliminate humans now. But when that person elects to either leave the dealership and or retire, you don't have to backfill them because now we've got a solution that can do effectively what they were doing before and allow slowly over time or more aggressively, for those dealers that want to be more aggressive, take costs out of their cost system. So I'd love to do an entire fund just on process automation tools at a dealership that just look at all the different roles. And I think phase one would be augmenting. We've heard a lot of promises around, a BDC, a business development center, and giving them tools so they have more throughput. You and I had this conversation last night over dinner. Eerily, and I'll give credit to Glenn Mercer for this point. Industry consultant, and for those of you that aren't following him, you should follow him at glennmercer.com. He gets up on stage and he says, 25 years ago, let's go pre-internet.
Yeah.
30 years ago, how many cars on average were being sold by the average salesperson?
10.
And last year?
10.
Exactly. So since then, we've had the internet. We've had all kinds of software solutions. Yet why is it that we haven't increased productivity? And I got to imagine it's the same thing. Billing per technician in service bays. I haven't done that work. Maybe Glenn can do that for us. But Glenn, if you're out there, we need that work done as well. But I'm trying to promote you as much as I can. But it's very interesting that despite all of this progress and all of these technology solutions, why is it that yield productivity per person, per employee at a dealership hasn't increased? And I'm going to ask you now, put you on the spot.
No.
Why do you think that is?
So I think there's more than one reason. I don't think there's ever one reason, but I think one of the big ones, and we touched on it earlier, and I'm going to bring this back to AI, which you mentioned before, is there's a lot of, first of all, there's a lot of functions in the store that exist today that didn't exist, 10, 5, 3 years ago. But also all those functions have their own problems, right? And they come up with their own software to solve those problems. And because of that, we stay really, really siloed. So yes, that salesperson's only selling 10 cars, but then there's all these other functions in the store, right? There's somebody in the office who's reconciling books and who's stocking in cars and literally just keying stuff in, but they live in this silo. And they work in one software system of however many the dealership has, so they can never really get more efficient, right? The dealership's doing more stuff, and it's certainly more efficient than handwriting it on paper, but we still have all these people. We actually have, it's almost, I think the average number of employees per store last year was 65. The highest it's ever been was 67. But you go back, to your point, 30 years ago, I have the numbers from 2007. And I think we were at 50, something like that. So that's like a big increase in a decade and a half. So, when you look at that, people, there's more people and they're doing more stuff, but it's all siloed out. And to see true efficiency, you need to break down those silos. You need to have kind of a single access to information, right? And when you can do that, then the software can handle a lot of the processes. But until you have that, the software is going to do its one job, and it'll help that one person do its one job, but it's still only doing that one job. You need to be able to spread it across multiple functions, multiple people, to be able to see true efficiency gains, I think. And I do think that ties back in also to the AI conversation, right? When you think about going forward, we're starting to see history repeat itself a little bit where it's like, okay, I have this AI tool that does this thing. and I have this AI tool that does this thing. And it's like, that's great. And it is going to help. But I think it's really important for dealers to look for ways to tie those together, right? And you think about, any AI tool, any automation tool, it's only as good as the data that it's being fed, right? At the end of the day, the software can only do stuff with the data that it's being fed. And even when you look at a large language model or any other type of artificial intelligence, that the data set is the important piece. So having that AI data layer for your tools to access all kind of at the same time is where I think you're going to see those true efficiency gains, way more so than just, all right, I got this one problem, let's fix it. And you have to start there. Don't get me wrong. I mean, I think you can't eat a whole elephant in one sitting, right? But kind of keeping that in mind, especially as a retailer, like how do I ensure that these kind of solutions to these problems that are siloed are able to be efficient in the long run?
Yep, that's a good point.
Does that track?
It does. It does. Let's try. Our mission should be to try to nudge up that sales per salesperson over the next 5 years.
Yeah.
And or ROs and billings per technician. I just think that something has to change here.
No, I think you're spot on.
I hope I don't go to my deathbed and we're still selling 10 cars per salesperson.
No, I was just having a conversation last month with one of our largest customers, and they were saying, what we need to figure out how to do is to sell more cars with fewer people. Like that's where we're at right now. It's that simple, and it's the exact same thing you're saying, because we've done a lot to perfect a lot of things in the store, right? To change things in a way that are positive for the dealership, for the dealership's employees, and for the consumer. But we got to get faster. We got to do more with less. To your point, to cut out some of that cost. Like we shouldn't have to have so much cost.
Yeah. So this is our call to entrepreneurs out there. If you're an entrepreneur out there, we want more innovation and solutions that help dealers increase throughput, yield per person, per employee, and should be able to do that now with AI. But let's help dealers that want to reduce costs, take out human capital, increase sales per salesperson, increase fixed operations per person as well, technician and service writer. And let's see if we get some entrepreneurs out there innovating in these spaces. I'd love to invest in those entrepreneurs. Right. Let me know if you want to do this, because I want to invest.
Yeah, no, I love it. I love it. It's
the checkbook is open.
There you go. I love it. Well, you'll probably have a new fund coming sometime soon.
There you go.
Right?
Exactly.
So you mentioned your new fund is more of a global mobility fund. So not to go too far. Well, I guess we can go as far down the rabbit hole as you want. But you also have a new book coming out around mobility, right? The future of mobility. So how do you define, I guess, when you say an automotive specific fund versus a mobility fund? How do you differentiate those? Is it just a broader net? Like is automotive inside of mobility? So it's just a broader net?
Yeah, so we need to be really clear on the swim lanes. And we have a lot of debate internally around this. So the dealer fund gets sort of like first crack at anything that helps a franchise dealer generate more revenue, take out costs, or run more efficiently. Everything else mobility related is fair game for the other two funds. Now the first fund's closed, but the second fund is open and we're rolling. So yeah, the way I like to think about mobility in an easy framework is if you're moving humans or cargo across the modalities of land, sea, air, or space, it's all fair game. Clearly, like the further you get from ground transportation, which is my background, the more compelling it needs to be.
Sure.
We invested in a company fairly recently that's using electromagnetic levitation and propulsion within a vacuum tube to actually move a payload at multi-Mach speeds to ultimately hit a ramp and project into lower Earth orbit. Pretty amazing stuff.
Yeah.
But you wouldn't need rockets, which is like 80-90% of the weight for launching a satellite into space. You wouldn't need any of that if you're able to actually accomplish this. The only reason we got very excited and underwrote that investment, well, there's a couple of reasons, but amazing entrepreneur who's very talented, with an idea that seems fairly airtight. The thesis is airtight; it hasn't been built yet. And then we've had the opportunity to work with other investors that are also investing in the round, who are smarter in those areas than us, and got very comfortable with at least the direction is right. But to your point, more of our investments have typically been around ground transportation and all the different facets of ground transportation.
Yeah. So that investment you just mentioned, that was similar to my 6th grade science fair project.
There you go.
So, the whole
Maybe she'll hire you.
levitating off the
Be
magnet.
careful.
Yeah, levitating off the magnet. And I built a little boat. We put liquid nitrogen in it to make it levitate.
Oh,
and
wow.
Sent it down the track. It was, if you've never played with liquid nitrogen, it's fun, actually.
Yeah, just watch your fingertips.
That's right. That's right. You can just throw it out on the concrete. It bubbles up. It's like you got marbles there. It's pretty cool.
Oh, yeah,
it's fun
yeah,
stuff.
yeah.
Something I'll never forget. That's
Right.
for sure.
And you didn't lose any fingers.
Nope. Got them all.
Good.
Got all 9 of them. Well, Steve, I could talk to you for days, I think, but I want to be super respectful of your time. So, maybe we could end on. So this is your book from a couple years ago, The Future of Automotive Retail. But at the end of this, there's a little story in there, the calf path. Mm-hmm. Could you share that? I don't know if everybody's familiar with it, but I think it's a great just representation of how. We can't always just keep doing the same stuff or keep getting a little better at the things that we're doing today. So I don't know, maybe you could share that story.
Yeah, you can find it online. It's a well-known poem, but when I read that, I was like, wow, how great. And I haven't yet had any dealers that have taken offense.
That's good.
But I do think it's a fascinating industry that you and I are in.
Yeah.
And the reason that 25 years later that I stayed in this industry is probably represented by that poem. The fact that you can out of both sides of your mouth say it's the most exciting time in history, the history of automotive, to be here. Not only the cars that are getting built now. Mm-hmm. We are living in this golden age of the car.
Yeah.
The cars built today, 20, 30 years from now, people were like, how on earth were these cars built? People were permitted to build these cars. Cars with factory warranties have over 1,000 horsepower.
Yeah.
It's really actually amazing to think about. I love the late 60s for cars, but the cars today are amazing. So we're living through this amazing time. The internet, 20 years ago, all this software that's been introduced to the system. Yet, as we've said today, progress in many cases isn't being made. The way that we've sold and serviced cars hasn't changed in 100 years. Yeah. And, COVID was this unique experiment where you would have thought we would have accelerated at-home buying of cars. Hasn't happened. No. And if it didn't through COVID, it's not going to happen.
Right.
Consumers still want to go to dealers. And, I'm more convinced than ever that the franchise dealer model is defensible and durable. And, it's I'll be long gone before there's ever any real threat to franchise dealers.
Yeah.
Right. Unless they do it to themselves.
Right.
So I think that it's fascinating to me. So this poem really, to me, represents the fact that we become rather set and dogmatic about the way we look at the world. And, there's the old saying about look outside the box, right? Or think outside the box. We need to challenge convention. I think all of us within the automotive space need to say, ask why we do the things we do. Mm-hmm. Because some of them are absolutely right, but many of these processes and things that we do, we've inherited from previous generations. And, I think we need to really challenge convention. The business that we're in as a VC, right, is challenging convention and thinking about, what is durable and not going to change, but more importantly, what things are going to change dramatically over the next 5 to 10 years. And then we want to place bets to participate in those things that are going to change that we can financially benefit from for the benefit of our investors. But I do think this poem really resonated with me.
Yeah. Yeah, no, that's great. Well, Steve, I really appreciate your time. Anything we haven't touched on that you want to hit on before we jump out of here? Or?
I'm sure lots, but I'll come back.
All right, that'd be great.
We'll do a second one.
That'd be great. All right, well, thanks so much for your time. I really appreciate it, and we'll talk soon.
Greg, thanks for having me.
Yeah. That was a great conversation with Steve Greenfield. I hope you enjoyed it as much as I did. One of our longest episodes yet, but totally worth it. Really appreciate him giving us all that time. Don't forget, before we hop off, you can watch or listen to all episodes of Connected on YouTube, Apple, or Spotify podcasts. And make sure to hit subscribe so you're notified every other week when new episodes are released. Thanks so much, and we'll see you in 2 weeks.